Welcome back to the Deep Dive. Our mission today is to really equip you with the knowledge that lets you cut through some pretty complex financial reports.
Right, and understand how wealth is actually created.
Or destroyed over time. We're diving deep into, I think, the foundation of all economic and corporate decision-making, the net present value.
Or NPV.
NPV. You might also hear it called net present worth, or NPW, but it's all the same idea.
It really is. I sometimes think of NPV as the financial physicist's approach to valuation. It's this universally accepted method for measuring the true value of any asset.
Anything that generates cash over time.
Exactly. Any investment, any capital project. It doesn't matter if you're a massive corporation looking at a multi-billion-dollar project or, just an individual weighing a new mortgage product.
Right.
NPV is the tool that standardizes that comparison. It puts dollars from different times on a level playing field.
And the whole reason we even need this calculation, why we can't just, add up the dollars, is this core principle of the time value of money. That concept sounds simple, but it is, it's the bedrock of everything we're going to talk about today.
It absolutely is the core philosophy. The time value of money, it just states unequivocally that a cash flow you get today is inherently more valuable than the exact same cash flow you might get in the future.
And the reason is opportunity.
Just opportunity. That dollar today can be immediately invested. You can put it to work. It can start earning returns, interest, dividends, whatever. A dollar you get tomorrow just can't.
So let's put that into a tangible context right away.
Yeah.
Using one of the examples from the material we looked at.
Okay.
Imagine you're presented with two options. Option A, I give you 99 cents right here, right now.
Okay, I have it in my hand.
Option B, I promise to give you $1, a full dollar, exactly 1 month from now.
I think most people would probably take the 99 cents.
Option A? Yeah.
The difference is just so negligible, for such a short period. The return you'd have to earn on that 99 cents over 30 days to make it equal $1 is tiny.
And what if we stretch that out?
Now that's where it gets interesting. If we shift that time frame dramatically, if that same $1 is guaranteed to arrive, say, 20 years from now.
Even if it's 100% certain.
Even if it's certain, its value today is significantly diminished.
And that reduction in current value, that's the critical element here. That's what's quantified by the discount rate.
The discount rate, yes, which represents the return you could be earning on that money somewhere else.
So if you look at a series of identical payments, maybe $1,000 every year for 10 years.
Okay.
That first $1,000 payment is the most valuable one.
And the 10th is the least valuable.
Exactly. And the whole purpose of NPV is to precisely calculate that rate of decay and then sum up the results.
And that discount rate, it reflects your risk, it reflects your inflation expectations, and crucially, your opportunity cost. It's the hurdle rate that any investment has to clear to even be considered worthwhile.
Okay, so let's unpack this. Our goal is to move beyond the theory and really understand the practical application. How does this calculation dictate whether a huge corporate initiative,
like a new factory,
right, or developing a new energy source, or launching some massive new product line, how does this tell us if it's genuinely creating economic wealth, or if it's just, a nominal illusion that's disguised by these big, flashy revenue projections way out in the future?
Well, to determine the NPV, you really follow a three-step process. The first step is all about mapping out the cash flows over the entire life of the investment.
The whole life.
The whole life. You calculate all the costs, which are your negative cash flows, your outflows, and all the benefits, your positive cash flows, your inflows, for every single period.
So if it's a 15-year project, we need 15 years worth of estimates, and we have to be really clear about when that money is actually supposed to move.
Exactly. Timing is absolutely everything here. Step two is it's the core intellectual work. You take the future value of each one of those cash flows.
One by one.
One by one. Whether it's a benefit you get in year 5 or maybe a big maintenance cost in year 9. And you discount it back to what it's worth today, its present value, or PV.
And you do that using that discount rate we just talked about.
Using that chosen periodic rate of return, yes.
Okay, so what's the final defining step?
Step 3. The NPV itself is just the sum of all those individually discounted future cash flows. And that includes the initial investment.
Ah, right.
So you sum up the present values of all the good stuff, the benefits, and you subtract the sum of the present values of all the bad stuff, the costs. And if you do it right, you're left with one single number.
One number.
The project's net value stated in today's dollars.
That distinction, benefits versus costs, I find that really helpful. So Essentially, NPV is like the financial residue.
That's a great way to put it.
It's the leftover amount, the difference between the total present value of the cash coming in and the total present value of the cash going out. So it's comparing the money you get versus the money you spend, but it's adjusted for those three critical factors: inflation, the riskiness of it all, and the opportunity you're giving up to make returns somewhere else.
And because of that clarity, and because it can handle these really complex long-term streams of income, NPV is the central component of what we call discounted cash flow analysis. DCF, which is the gold standard for valuing businesses, assets, you name it. It's used across finance, economics, and corporate accounting, globally.
So once we have that number, that final calculated NPV, how do we actually use it to make a decision? That brings us to what's called the net present value rule.
It's remarkably elegant in its simplicity. If the NPV is greater than 0,
A positive number.
the project is projected to add value to the firm. It means the present value of all the benefits exceeds the present value of all the costs.
So you should do it.
You should pursue it, assuming, of course, you have the capital to fund it in the first place.
So it represents genuine net wealth creation above and beyond what it costs you to just finance the project.
Precisely. Now, conversely, if the NPV is less than 0, so a negative number,
That's bad.
that's bad. The investment is expected to subtract value from the firm. The projected earnings, once you adjust them for time and risk, they just don't cover the present value of the costs.
So that project is financially unsound. You reject it.
Generally, yes. You reject it.
Okay, but what about that tricky middle ground? What if the NPV lands exactly on 0?
That indicates a state of, well, financial indifference. At an NPV of 0, the project is projected to neither gain nor lose monetary value. It basically means the investment's own internal rate of return exactly matches your required discount rate.
It's a wash.
It's a wash financially. So in that scenario, the decision to go ahead or not has to rely completely on non-monetary criteria.
Like what?
Oh, maybe regulatory compliance, or strategic positioning, blocking a competitor, or maybe it supports another part of your business. But financially, it's neutral.
Okay, that really sets the stage for how to interpret the result. But to truly understand why some projects fail this test, we have to look under the hood. Let's get into the mathematical components.
I think we have to.
Let's break down the variables in that formula.
Understanding the formula, it really connects all the concepts we've discussed. The correlationship starts with calculating the present value, the PV, of just a single future cash flow.
Okay.
That formula is PV equals the cash flow at time t, which we call R sub t, divided by the quantity 1 plus I, all raised to the power of t.
Right, and the generalized NPV is just summing all of those individual present values up, from time 0 all the way to the final period, which we call n.
Right, the summation.
So let's define those variables again, just to be crystal clear, starting with t.
So t is simply the time period when the cash flow happens. It starts at t equals 0 for your initial investment.
The day you write the check.
The day you write the check. And the convention here, which is really important for mathematical rigor, is that we assume future flows happen at the end of each period.
The end of the year or the end of the quarter.
Exactly. And that's the standard because it's the most conservative approach.
And I, this is the rate we've been really emphasizing.
I is the discount rate. You should think of it as the minimum hurdle the project has to clear just to earn its spot at the investment table.
Right.
It's the required return on an investment with similar risk, and it incorporates that opportunity cost of capital, what the firm is giving up, by putting its money here instead of the next best alternative.
And R sub t is just the money itself, moving in or out.
R sub t is the net cash flow, so inflow minus outflow at that specific time t. And we have to remember, it can be positive, revenue or benefits, or it can be negative, like costs and expenses.
And at time 0, t equals 0, that R sub 0 is usually a big negative number.
It's usually your big initial cash outlay, yes.
The denominator, that's the key to that financial erosion we talked about.
It's the engine of discounting. That 1 divided by 1 plus I to the t part is called the discount factor, or sometimes the present value factor.
And if you think about it, the higher the rate I, or the longer the time t, the smaller that factor becomes.
It shrinks exponentially. If t's is 20 years and I is 10%, that factor is tiny. It makes that future dollar worth very, very little today.
And this is the part I find really fascinating, connecting this, sort of technical formula to a much clearer concept.
Mm-hmm.
We defined the generalized formula as this single sum, But the sources point out that it's often cleaner for decision makers to express it as a difference.
Right. The difference between discounted benefits and costs, that's the conceptual heart of it. NPV equals the present value of the benefits minus the present value of the costs.
So you do two separate calculations.
Two separate summations. You calculate the PV of all your future benefits, B, and then you calculate the PV of all your future costs, C. The difference between those two totals, once they're both in today's dollars, is your net present value.
That framework really helps managers visualize the trade-off, doesn't it?
Mm-hmm.
It clearly separates the money coming in from the money going out, all standardized to the present. I always picture the CEO standing there with the checkbook open at T equals 0.
Mm-hmm.
That initial cash goes out immediately, no discounting needed.
And that visualization relates directly back to that initial investment, R sub 0. The general convention is that your initial investments, your cash outlays, they're summed up as a negative cash flow, but they're not mathematically discounted.
Why not?
Because they happen immediately at time T equals 0. They are already at their present value.
Okay, to really drive home the power of this discounting process, I think we have to move away from the algebra and get into a detailed corporate scenario.
I agree. This is the moment where those nominal future dollars just sort of collapse under the weight of time.
Let's use the specific project decision that was outlined in the material.
Yep.
A corporation is evaluating whether to launch a new product line.
And it requires a significant capital investment right up front.
Okay, so the initial capital expenditure at time T equals 0 is a negative cash flow of negative $100,000.
$100,000 out the door today. Then the product is expected to generate these really reliable, consistent benefits cash inflows of $10,000 a year for 12 years.
And that starts at year 1.
Starting at T equals 1. And we'll assume those are net figures, so operating costs are already taken out.
Okay, let's stop right there. If we were, amateur analysts, we would just add up the nominal values. A $100,000 investment yields $120,000 in total returns.
Right, 12 years times 10,000.
That's a $20,000 profit. Seems like an obvious yes.
It seems obviously profitable if you ignore the time value of money. But we have to apply the firm's effective annual discount rate.
And in this case, it's 10%.
10%. This represents what they could reliably earn somewhere else on a project with similar risk. Now we have to walk through the calculation and watch that profit just vanish.
Yeah. Okay, so the $100,000 cost at T equals 0, that stays $100,000. That's our benchmark.
That's the benchmark. Now for the inflows, that first $10,000, the one you receive in year 1, is discounted once.
Okay.
So its present value is just over $9,090. We've already lost almost $1,000 in present value in just 12 months.
And by year 2, that $10,000 is only worth about $8,200. The compounding effect is now fully in play.
And the decay just accelerates. By the time we look at the cash flow arriving 5 years from now, that same $10,000 is only worth $6,209 today.
Wow.
The firm is waiting 5 years to get that money. During that time, it could have been generating a 10% compounded return if it had it sooner.
This compounding effect is staggering. If we jump all the way to the end, to T equals 12,
The final payment.
that final $10,000 payment is worth a mere $3,186 in present-day money.
Less than a third of its face value.
It is the ultimate illustration of why distance in time is the enemy of value.
So when we do the full summation, the total present value of all 12 of those $10,000 cash flows comes to only $68,136.91.
So what does this all mean for the decision maker?
Well, the present value of all the benefits is $68,000. The present value of the cost is $100,000.
So the NPV is negative $31,863.
A huge loss. The project should be shelved immediately. While it looks like it makes a nominal profit of $20,000, the calculation reveals that by tying up that $100,000 for 12 years, the company is actually destroying value.
It's equivalent to just losing almost $32,000 today.
Exactly.
That is a stunning real-world application. It really proves why NPV is so essential.
Yeah.
But this analysis, as rigorous as it is, it rests on some key implicit assumptions that we have to make explicit.
Yes, every model has them.
So what are the constraints that are baked into this simple 12-year example?
Well, the first assumption is about the project lifecycle. We're assuming that the investment horizon of this project, 12 years, is equally acceptable when you compare it to any other competing project. We're treating a 12-year commitment as neither good nor bad compared to a 5-year one.
Which might not be true.
It often requires further analysis to justify.
Okay, what's the second assumption?
It involves the rate itself. We assumed a 10% discount rate. We have to assume that this rate is appropriate, that it's stable, and that it accurately reflects the risk level of this specific project for the entire 12 years.
A lot of assumptions there.
A lot of assumptions. And the third one brings it back to corporate governance. We are assuming that the firm's owners, the shareholders, can't achieve a better return, a return above that 10%, somewhere else at a similar risk level.
Ah, right, if they could get 12% on their own.
If external investors could reliably earn 12% on a similar risk investment, the firm should just liquidate the project, return the capital, and let the shareholders invest it themselves. That would maximize their collective wealth.
That brings it right back to opportunity cost, which is just the relentless driver behind all sound financial theory. The capital has to be employed in its most efficient use. Always.
And to make that opportunity cost even more visceral, let's revisit that simple lottery analogy.
Okay.
Imagine you win a $500 million lottery, but it's paid out in equal installments over 20 years. That's the nominal value, $500 million.
But when you choose the cash option, you get a single immediate lump sum. And that lump sum, which is the NPV of that future stream of payments, is usually about $285 million.
Right. So where did the other $215 million go?
It's not a scam or a deduction.
Not at all. It is the financial value of the time difference. It's the amount that the Lottery Commission expects to earn by investing that cash stream over 20 years before they have to pay it all out to you.
So that value belongs to whoever holds the capital.
Exactly. And if you take the lump sum, you get the opportunity to earn that return yourself.
That example really shows that everything hinges on that discount rate, the 10% or whatever rate we choose. But what happens if we get that critical variable, either wrong? How do sophisticated firms decide which rate to use?
The selection of the discount rate is probably the single most important and, frankly, the most frequently debated step in the entire NPV process.
I can imagine.
The most common choice, sort of the starting point, is the firm's weighted average cost of capital.
The WACC.
The WACC. This represents the blended average rate the company pays to finance its assets, considering both its debt and its equity, and it's usually calculated after tax.
So why is WACC the default baseline?
Because the WACC represents the minimum return the firm has to earn on its existing asset base just to satisfy its creditors and its shareholders. So if a new project can't even earn the WACC, it's mathematically diluting shareholder value.
Assuming the new project has the same risk as the rest of the company.
That's the key assumption, yes. But it's just a baseline, and many experts argue for adjustments.
They do. In practice, WACC gets adjusted in two main ways. First, professionals will often argue for a higher discount rate to adjust for higher perceived risk in a specific project.
Or to better reflect the true opportunity cost of that capital.
Right. And
Second, they might use a variable discount rate, so you'd apply higher rates to cash flows that happen much, much further in the future. This reflects what's called the yield curve premium, where long-term debt often requires higher yields than short-term debt, just because there's more uncertainty over longer horizons.
Tell us more about the opportunity cost method. It seems a bit more sophisticated than just using a blended corporate average like WACC.
It is. The opportunity cost approach dictates that the discount rate you use for a specific project should be the rate of return that the capital for that project could return if you invested it in the best available alternative.
So an example.
Let's say Project A requires $100 million in capital, and the firm knows that same $100 million could reliably earn 8% in Project B.
Then you have to use 8% for Project A.
You should use 8% as the discount rate for Project A. That ensures that Project A is only accepted if it actually outperforms the next best option you have.
Which makes perfect sense.
And this leads directly to the concept of the firm's internal reinvestment rate. The reinvestment rate is the average rate of return the firm achieves on its general pool of internal investments.
So why would a firm choose to use the reinvestment rate instead of WACC? I mean, isn't WACC usually close enough?
That's a good challenge. WACC is easy to calculate, it's legally defensible, however, in a capital-constrained environment.
Meaning you have more good ideas than you have cash?
Exactly. You have more positive NPV projects than available cash. In that world, the true opportunity cost is often much higher than the WACC. Imagine a firm with high internal demand for capital, Every dollar you commit to a new factory means a dollar that you can't use to upgrade software that's currently yielding a 20% return.
So in that scenario,
In that scenario, using the firm's average reinvestment rate, which captures the high return of those internal projects, gives you a much better benchmark for maximizing value than the potentially lower blended WACC would.
so the goal dictates the rate. If you just want to know if a project clears the basic hurdle of funding, WACC is fine.
It works.
But if you're trying to maximize value and prioritize between competing mutually exclusive projects, the corporate reinvestment rate might be superior because it's benchmarking against the best internal use of that limited cash.
That is the critical distinction. And speaking of sophisticated adjustments, the sources introduce a superior methodology for handling risk, though it does require a bit more analytical work.
And that is,
The risk-adjusted net present value, or RNPV.
I understand that just adding a premium to the discount rate for risk is a bit imprecise because of that compounding effect. So how does RMPV solve that?
Well, RNPV separates the risk quantification from the time value calculation. So instead of just bumping up the discount rate I, the RNPV methodology suggests explicitly correcting the cash flows themselves for risk first.
How do you do that?
You use a probability factor, let's call it P, to reduce the expected cash flow, R sub T, reflecting the probability of success or failure.
So if a drug trial in year 3 has only a 60% chance of success, we only value 60% of that potential cash flow.
Exactly. The formula essentially becomes you discount the quantity of P times R sub T, you correct the cash flow for the probability of ever receiving it, and then you discount that adjusted cash flow using the firm's normal standard WACC or risk-free rate.
So you separate the two problems, valuing the risk and then valuing the time. Much cleaner.
Much cleaner, much less subjective, and it gives you a much more robust framework for risk management. This is particularly crucial for, say, international projects or R&D, where success rates are highly variable.
The last application in this section, it deals with a really common challenge for managers. How do you compare projects of wildly different scales, especially when capital is limited?
The bang for your buck problem.
This is the concept of capital efficiency, measured by the net present value per dollar invested, or NPVI.
This metric answers that exact question. Which project yields the biggest bang for my buck? It adjusts the raw NPV result to show the project's contribution per dollar of initial investment. It's a prioritization tool.
How do we calculate it?
The standard calculation is your discounted benefits minus your discounted costs, all divided by the discounted costs. But it's often mathematically equivalent to just taking the raw NPV and dividing it by the initial investment cost.
Okay, let's use the sources example to make that ratio concrete.
So suppose we have Project A. The discounted benefits over its life are $100 million. The discounted costs are $60 million.
So the NPV is $40 million.
The NTV is $40 million. The NPV is that $40 million divided by the $60 million in costs, which comes out to about 0.6667.
Okay, what does that number mean?
It means for every single dollar the firm commits to Project A, it generates about 67 cents of net present value wealth.
Okay. Now what about Project B?
Now imagine Project B has a lower NPV, say $30 million, but it only requires a $20 million initial investment. Its NPVI is $30 million divided by $20 million.
Which is 1.5.
1.5.
Wait, so Project A has a higher absolute NPV, the $40 million, but Project B has a far higher NPVI.
Exactly. And if the firm is capital constrained and can only afford one or the other, or if they need to stretch their limited budget, Project B, despite its lower absolute NPV, is the superior investment.
Because it's more efficient.
It yields $1.50 of value for every dollar you invest, compared to Project A's 67 cents. NPVI maximizes the efficient deployment of scarce capital.
That's powerful. It moves us away from just ranking by the raw dollar amount to ranking by capital productivity.
Yeah.
Okay, let's shift gears into some of the theoretical nuances and assumptions that are buried in these mechanics, especially around time.
Right.
We talked about T, the timing of the cash flows, and how that assumption matters.
And it matters significantly. As we noted, the standard NTV formula, it assumes all your benefits and costs occur precisely at the end of each period.
Which is simple, but not very realistic.
Not always.
All right.
And it's considered the most conservative approach.
Why conservative?
Because by pushing the income to the latest possible date, the end of the year, you maximize the duration of time over which it has to be discounted. This gives you the lowest possible or most conservative NPV result. And in finance, conservatism is generally preferred.
But if cash flows are really spread out through the year, we might be misrepresenting the true value of the project.
And that's where mid-period discounting comes in. In many projects, like retail sales or utility billing, cash flows arrive more or less continuously throughout the year.
Right.
So if we assume the cash flow is distributed evenly, the average time the money is received is the middle of the period. So we discount from T minus zero point 0.5.
And what's the impact on the final number?
It results in a higher NPV than the standard method because you're discounting the benefits for half a period less time. So it gives you a more accurate representation if the cash flows are genuinely continuous, but it's inherently less conservative,
And then there's the least conservative method of all.
which is beginning of period discounting. This assumes all cash flows arrive immediately at the start of the period. This gives you the highest possible, least conservative NPV. It's not standard for external reporting, but understanding these timing nuances is really critical for internal managers who want their models to closely match the reality of their operational cash cycles.
Okay, now for a brief moment of high-level theory, I think it's useful to see that NPV isn't just some accounting trick, but it's a profoundly rigorous concept.
Absolutely. What's fascinating here is that the time-discrete NPV summation that we use is functionally equivalent to an integral transform of the cash flow stream. It's similar to how electrical engineers analyze signals.
We don't need the calculus here, but what's the conceptual link?
The conceptual takeaway is powerful. The discount rate, it essentially represents the damping inherent in the system.
Damping.
In system dynamics, the math separates complex values into real and imaginary parts. The real part relates directly to the effect of compound interest, that relentless exponential decay of value over time. It shows how a fixed cash flow signal is dampened as it moves into the future.
So the higher the real part, which is like a higher discount rate, the faster the signal fades and the lower the present value.
Precisely. And the imaginary parts describe cyclical or oscillating behavior. Now, in finance, this doesn't mean your cash flows are literally oscillating, but it provides a framework to analyze business phenomena like cyclical revenues, inventory management cycles, or price shifts, like the famous pork cycle in agriculture. The fact that the financial discount rate maps to these dynamic system concepts, it just confirms the deep theoretical rigor that's underpinning NPV analysis.
So we can view a project not as a static stream, but as a dynamic system responding to time and rates.
That's the idea.
That provides fantastic context. It ensures we know this tool is built on solid, fundamental mathematics. Let's pivot now to the critical analysis, the advantages, the disadvantages, and the dangerous pitfalls managers can run into.
Starting with the advantages, which are, why it's the standard tool. First and foremost, NPV is the only method that rigorously and consistently considers the time value of money.
Which makes it consistent with maximizing shareholder wealth.
Entirely. It's measuring true economic profit.
Second, it gives you an unambiguous dollar value. There's no confusion.
Yep.
A project with an NPV of plus 20 million is just quantitatively better than one with an NPV of plus 5 million, assuming your inputs were right.
And crucially, it accounts for differences in cash flow timing and size, because every single cash flow is adjusted individually based on how far away it is and how big it is. It handles uneven or irregular cash flow patterns perfectly.
And finally, that additivity property is immensely useful for corporate finance.
It is. The NPVs of separate, independent projects can just be summed up to calculate the total expected change in the firm's wealth. If a firm takes on 5 projects, the sum of their individual NPVs is the expected total wealth creation. It makes portfolio management much cleaner.
Okay, now for the critical disadvantages, because no model is perfect. The first problem, which I imagine gives planners a lot of anxiety, is the heavy reliance on subjective inputs.
It's the garbage in, garbage out problem.
Yeah.
NPV's accuracy is hypersensitive to the correctness of your inputs. You need to correctly predict future cash flow amounts, often 10, 15, even 20 years out.
Which is basically impossible.
It's an educated guess at best. You need the precise timing of those flows, the project's exact lifespan. If the cash flows you predicted for year 15 are off by even 15%, your final NPV is structurally flawed.
And this is why we need sensitivity analysis.
You have to do it. Any responsible financial analyst performs sensitivity analysis. They model how the NPV changes if they vary the discount rate or the initial cost or the future revenue forecasts. This helps you identify the key variables that carry the most risk and uncertainty. It turns the NPV from a single number into a range of possibilities.
The second major disadvantage is the reliance on the discount rate's accuracy and stability.
Yes. We've emphasized that the discount rate is supposed to represent the true risk premium, but it's typically assumed to be constant over the entire investment life.
Which is never true.
In reality, the cost of capital changes over time. If a firm's credit rating improves or if market interest rates spike 3 years into a project, the true cost of capital is different from that constant IU assumed. The whole result is only as accurate as that initial hurdle rate choice.
Third, NPV is purely quantitative. It's like a financial calculation, which means it suffers from a lack of context.
It gives you a number, but it completely ignores critical non-financial metrics. It doesn't factor in employee morale, brand reputation, regulatory burden, market dominance, or the strategic value of blocking a competitor.
And those qualitative factors might easily outweigh a small positive NPV.
Easily. But the model itself can't capture them.
And finally, the difficulty of comparing mutually exclusive projects with different investment horizons.
This is a classic problem. If you're comparing two machines, machine A lasts 3 years, machine B lasts 7 years, and you can only buy one, the raw NPV calculation can be misleading. You generally have to use more advanced techniques to standardize the comparison.
Okay, now let's talk about the common pitfalls. Those hidden traps that non-specialists frequently fall into when they start using NPV in spreadsheets. The first one is entirely counterintuitive: the effect of late negative cash flows.
This is a critical warning. Imagine a mining company or maybe a nuclear power plant project. The big positive cash flows happen in years 5 through 15.
Right.
But there are massive environmental cleanup or decommissioning costs, huge negative cash flows way out in year 25.
So if the firm uses a very high discount rate, say 18%, to reflect the risk of the industry, that high rate should signal caution, right?
And that's the trap. A high discount rate is actually optimistic when it comes to future costs.
How can that be?
Because the discount factor shrinks exponentially. Discounting that massive negative cleanup cost in year 25 by 18% reduces its present value effect to almost nothing. The present value of that enormous future liability is artificially minimized. The project looks artificially profitable today because the future loss is mathematically neutralized by the high discount rate.
That is a crucial distinction. High discount rates minimize future negative impacts, which makes them dangerous when liabilities are involved. And that connects directly to the second pitfall: the error of just adjusting for risk by adding a premium to the discount rate.
It's the most common shortcut, and it's often the most flawed. If the firm's WACC is 8% and the project is risky, a manager might instinctively say, oh, let's just add a 5% risk premium.
Making the discount rate 13%. The problem isn't the premium itself, but the compounding effect over time.
Exactly. When you compound that extra 5% risk premium over 20 years, the resulting NPV is far, far lower than if you had handled the risk explicitly using RMPV or scenario analysis. It disproportionately penalizes your future cash flows for risk.
So marginally profitable projects get rejected.
They get unjustly rejected because the compounded discount rate reduces the true value of future gains too aggressively, making the firm unduly conservative.
The third pitfall involves what we call double counting the time value of money. And this relates directly back to how we define that cash flow, R sub T.
This error happens when financial modeling relies on cash flows calculated after you've already deducted interest expense. This is a common accounting practice, but it's deadly for NPV.
Why?
Remember, the discount rate is supposed to represent the firm's cost of capital, which includes the cost of debt, which is interest.
So if you calculate the cash flow after deducting interest, and then you discount that cash flow stream using a rate that already incorporates the cost of debt.
You're effectively accounting for the cost of capital twice. You should always use free cash flow to the firm, or FCFF, as the basis for NPV calculations. That measures the cash generated before any interest deductions. Using cash flow after interest gives you a systematically miscalculated and usually understated NPV.
And finally, a very practical warning for anyone who might actually use this in a professional environment: the standard spreadsheet function error.
This is critical for practical application. The standard spreadsheet function, NPV rate, value 1, value 2, it assumes two things that are often wrong. First, it assumes constant, perfectly equidistant time periods between all your cash flows, which is rarely true in a real project.
And the second error is more dangerous. It's about the initial investment.
It is. The function incorrectly assumes the item in the first position of your cash flow array is period 1, which means it discounts that first value by one period too many.
But the initial investment is period 0.
It's R sub 0, and it should not be discounted. So this function reduces the value of your initial outlay, giving you an inaccurate NPV right from the start.
So the essential takeaway, if you have cash flows that are irregular in size or timing, or if you need to include the initial investment, you have to use the XNPV formula.
XNPV, rate, values, dates. It handles irregular time periods and correctly treats the initial investment at t equals 0 as non-discounted. Or, if you must use the standard NPV function, you have to manually add the initial non-discounted investment to the result of the function, which starts its discounting at year 1.
This detailed critique really shows us that while NPV is foundational, it's not omniscient. It needs to be part of a larger toolkit. So let's round out our discussion by outlining some of the alternative capital budgeting methods, many of which address NPV's specific drawbacks.
I think we have to. Managers rarely rely on just a single metric. These alternative methods provide different lenses through which to view a project's viability, its risk, and its structural fit within the organization.
Okay, let's start with the most famous counterpart to NPV, the internal rate of return,
IRR.
IRR.
IRR is the calculated rate of return of a project. It's defined as the discount rate at which the NPV of the project becomes exactly 0. It's immensely popular because managers often prefer talking in percentages.
This project returns 15%.
Right, rather than, this project adds $20 million in value. But the drawback is that it completely disregards the absolute dollar amount you gain.
So a tiny project could have a huge IRR.
Exactly. You could have a tiny $1,000 project with a 50% IRR and a massive factory that returns a 15% IRR. The 15% project adds significantly more actual wealth to the firm despite the lower percentage. IRR can lead to poor decisions when you're comparing projects of different sizes.
Following that is the modified internal rate of return, MIR.
MIR tries to fix the main flaw of standard IRR. Traditional IRR implicitly assumes that the cash flows generated by the project can be reinvested at the project's own high IRR rate, which is often unrealistic.
So MIR is more realistic.
It forces the manager to make an explicit, specified assumption about the reinvestment rate, usually the firm's WACC. This makes MIR a superior calculation, though it's still not as robust as NPV.
Next, we have the simplest metric, the payback period.
The payback period just measures the time required for the cash inflows to equal the initial outlay, the time it takes you to break even.
So it's a measure of risk, not return.
Exactly. A shorter payback period signals a less risky project because your capital is exposed for a shorter time, but it's fundamentally flawed for valuation because it completely ignores any cash flows that happen after the break-even point.
So a project could pay back in 2 years and then lose a fortune in year 3.
And the payback period would miss that entirely.
Then there's the accounting rate of return, ARR.
ARR is a ratio that accountants often use. It looks at the average annual net income generated against the initial investment. It's simple, but its structural flaw, and why finance departments reject it, is that ARR does not account for the time value of money. It treats $1 in year 1 the same as $1 in year 10.
Okay, moving to more advanced specialized techniques, we have the adjusted present value, APV.
APV is specifically designed to value projects that involve complex or changing capital structures. It separates the investment decision from the financing decision.
How does it do that?
First, the analyst values the project as if it were financed entirely by equity, the unleveraged value. Then, separately, they calculate and add the present value of all the benefits that come from the financing, particularly the tax shield you get from using debt.
And why separate those?
Because the value of the project itself is independent of how the firm chooses to finance it. APV explicitly shows the value the firm gets just from the tax benefit of taking on debt, which standard NTV calculations often just lump into the WACC, making it harder to see the individual value components.
Next, the equivalent annual cost, or EAC. This addresses that problem of unequal project lifespans we mentioned earlier.
EAC is exceptionally useful for comparing mutually exclusive assets with unequal life cycles, like comparing a 3-year truck replacement plan against a 7-year machinery lease.
So it puts them on a level playing field.
It calculates the cost per year of owning and operating an asset over its entire life. It essentially transforms the total negative NPV into an equivalent annual expense, allowing you to compare the normalized annualized cost of the 3-year plan directly against the 7-year plan.
Assuming they have equal risk.
That is the vital caveat, yes.
And finally, the broadest framework, cost-benefit analysis. CBA.
CBA is a systematic approach often used in public policy and infrastructure planning that goes beyond pure cash flow. It attempts to estimate the strengths and weaknesses of alternatives by including non-cash societal issues alongside the monetary costs and benefits.
So when a government decides on a new highway, they use CBA to value things like reduced travel time or increased productivity or maybe reduced pollution.
Yes, it tries to quantify the value of time savings or environmental impact and includes those in the discounted cash flow framework. It introduces a lot of subjective valuations. How do you accurately value reduced travel time? But it offers a necessary holistic picture that pure NPV, which is restricted to internal cash transactions, just cannot provide.
This entire deep dive really shows that NPV is an elegant and powerful mechanism. It transforms this scattered stream of future dollars into one single comparable current day value. It really is the essential filter for financial decisions aimed at maximizing wealth.
It is. We've established that NPV is the rigorous calculation for what should happen in a fixed scenario. The models assume you decide today, and you follow that plan relentlessly for the next 15 years.
But we know that in the real world, management is dynamic. They have flexibility. They might see a market opportunity in year 5 and choose to expand the factory.
Or see a new competitor and decide to abandon the project in year 2.
Right.
And precisely, that managerial flexibility, the right, but not the obligation to change your strategy, has a quantifiable value that the static NPV calculation completely ignores.
And this leads to our provocative final thought for you to consider.
Which is the field of real options.
Real options attempts to value that optionality.
Yes. If NPV is the rigorous calculation for what should happen under a fixed set of assumptions, how should we quantify the intrinsic value of having the option to change our minds? If a company can pay slightly more today for a facility that allows them to double capacity in 3 years if the market improves, that option itself is an asset.
And that's often the most valuable asset in an uncertain business climate.
It is. And modern financial theory is constantly pushing the boundaries of how to integrate that real options valuation on top of the traditional NPV result.
Understanding what NPV measures and what it deliberately leaves out is the key to becoming a truly well-informed modern decision maker.